Welcome back to the Daily Crypto Roundup. Today is one of those days where the market looks ugly on the screen, but underneath the panic, there is actually a lot going on that serious crypto investors need to understand. Bitcoin has dropped below $73,000 after fresh US strikes on Iran brought geopolitical fear straight back into the market. Nearly $1 billion in leveraged crypto positions has been wiped out. Long traders have been hit hard. Ethereum has slipped below $2,000. XRP has dropped back toward $1.28. Solana is under pressure near $80, and Dogecoin is sitting under 10 cents again. So yes, today looks rough, but this is exactly why we do the roundup properly. Not just to say prices are down, but to explain why they are down, what the bigger picture is, and what investors should actually be watching next. The first major story today is Bitcoin falling below $73,000 after US airstrikes on an Iranian military site near the Strait of Hormuz. That matters because the Strait of Hormuz is one of the most important energy choke points in the world. When tensions rise there, markets immediately start pricing in the risk of oil disruption, higher energy prices, inflation pressure, and a more cautious mood across global assets. Crypto is not sitting in its own little bubble anymore. Bitcoin trades like a global liquidity asset, and when war risk comes back, leveraged traders often get wiped out first. And that is exactly what happened. The sell-off triggered almost $1 billion in crypto liquidations in 24 hours, and the important detail is that the overwhelming majority came from long positions. That tells us traders were leaning bullish. They expected Bitcoin to hold the range, maybe bounce from support, and maybe recover after weeks of sideways action. Instead, the market got hit with a geopolitical shock. Bitcoin broke lower, and all those overconfident leveraged positions were forced out. That is why the move felt so sharp. It was not just normal selling, it was forced selling. Bitcoin traded down near $72,900. Ethereum fell through the $2,000 level. Solana dropped toward $80. XRP slipped toward $1.28, and Dogecoin fell below 10 cents. When you see that kind of move across the majors, it is usually not about one coin suddenly becoming weak. It is a broad risk-off move. Traders sell what they can sell. Leverage gets reduced. Margin calls hit. Algorithms react. And before long, a market that looked calm suddenly looks like it is falling apart. But here is the part listeners need to remember. Liquidation events can feel brutal in the moment, but they also reset the market. When nearly $1 billion in leveraged positions gets flushed out, it removes some of the excess risk that built up during the previous range. That does not mean Bitcoin has to bounce instantly. It does not mean the bottom is definitely in. But it does mean the market becomes cleaner after the worst leverage is cleared. The danger comes when people confuse a leverage wipeout with the entire long-term thesis breaking. Those are not the same thing. The second story today is the warning from fund manager Michael Kramer, who says Bitcoin could be heading much lower because of a major US Treasury liquidity drain. His argument is that upcoming Treasury operations could pull roughly $150 billion of liquidity out of the financial system between the end of May and early June. In simple terms, when the US Treasury issues bills and bonds, cash moves from investors into the Treasury's account at the Federal Reserve. That can temporarily reduce the amount of money available to move through markets. And when liquidity gets tighter, risk assets usually feel it first. That matters for Bitcoin because Bitcoin has increasingly behaved like a high-sensitivity liquidity indicator. When liquidity is abundant, Bitcoin often moves higher before traditional markets fully wake up. But when liquidity tightens, Bitcoin can also sell off early. Kramer's point is that Bitcoin breaking below $75,000 may already be showing that liquidity conditions are turning more difficult. Bitcoin is now down around 11% from recent highs above $82,500, so the warning is not coming from nowhere. The market has already started to crack technically. From a technical point of view, $75,000 was the level traders wanted Bitcoin to defend. Losing that area turns attention to the next support zones. If Bitcoin cannot quickly reclaim 73 to 75,000, traders will start watching the low 70,000s, then potentially the high 60,000s if panic continues. That does not mean Bitcoin is guaranteed to collapse, but it does mean the market is now in a more fragile position. The bulls need to show strength quickly, or the bears will try to press the move lower. However, this is also where we need to stay balanced. A liquidity drain is not the same as a permanent destruction of demand. Treasury settlements can create temporary pressure, especially when they hit during a geopolitical shock. But once that pressure passes, markets can stabilize if buyers return, ETF flows improve, or macro fear cools down. So the key question is not just, can Bitcoin fall lower? Of course it can. The real question is whether long-term holders, institutions, and ETF buyers step back in when the forced selling slows down. Now, before we continue, today's episode is brought to you by Kraken, our official exchange partner. And this actually ties directly into one of today's biggest stories, because Kraken has just rolled out a new Bitcoin Vault yield product for long-term Bitcoin holders. The idea is simple. For people who want to maintain exposure to Bitcoin while potentially earning Bitcoin-denominated yield, Kraken is expanding its earn products with a vault designed around long-term holding rather than short-term trading. Now, as always, this is not financial advice. Crypto carries risk, yield products carry risk, and you should always understand what you are using before you put money anywhere. But the bigger point is this. Kraken is clearly building for people who do not just want to gamble on daily candles. They are building tools for people who want to hold, manage, and potentially earn from their crypto over time. And because Kraken is our official exchange partner, we are also running our listener sign-up incentive. If you sign up using our Kraken link in the description, we will send you 20 XRP as a thank you. Make sure you use our link, follow the instructions properly, and keep an eye on the show notes for the details. Again, not financial advice. Crypto trading involves risk of loss. But if you are looking for a major exchange to explore Bitcoin, XRP, Ethereum, Solana, and the wider crypto market, Kraken is well worth a look. The Kraken story is important beyond just the sponsor angle as well. During sell-offs, a lot of weak market participants disappear. But exchanges, custodians, and infrastructure companies keep building. That is one of the biggest differences between people who panic and people who understand cycles. Retail traders often focus only on today's red candle. Serious companies focus on where the market is going over the next 3 to 5 years. Kraken launching more Bitcoin-focused products in the middle of market stress tells you that major platforms still see long-term demand for Bitcoin exposure. The next story is regulatory, and it is a big one. The US CFTC has filed a request to erase a Gemini settlement that it now says it no longer considers fair. Gemini had previously agreed to resolve an enforcement action involving a $5 million fine and other requirements. But the CFTC's current leadership has reviewed the case and said the complaint should not have been filed under today's enforcement standards. That is a major signal. It shows how quickly the US regulatory tone toward crypto has shifted. Under the current administration, regulators appear far more willing to reassess older enforcement actions and move toward a more industry-friendly approach. Whether you like Gemini or not, the bigger issue is the message this sends to the market. If regulators are willing to revisit old cases, exchanges and crypto companies may feel more confident operating in the United States. For investors, regulation is not always exciting, but it is one of the biggest drivers of long-term market structure. If US agencies move away from regulation by enforcement and toward clearer rules, that can support institutional participation. It does not mean every crypto project wins. It does not mean bad actors disappear. But it does mean serious companies may have a clearer path to operate, launch products, and attract capital. That is why this Gemini story matters. It is not just about one exchange. It is about whether America is becoming more open to crypto infrastructure. The final story today takes us to South Korea, where crypto trading activity has crashed compared with the local stock market. According to reports, trading across major South Korean exchanges, including Upbit, BitHum, Coinon, Corbit, and GoPax, fell to just 8% of KOSPI trading volume in May. That is a massive change from the previous cycle, when South Korea was one of the hottest crypto trading regions in the world, and retail demand could send altcoins flying. This matters because South Korea has historically been one of the clearest measures of retail appetite. When Korean crypto volumes are exploding, it usually tells you retail speculation is alive. When volumes collapse relative to stocks, it tells you retail attention has moved elsewhere. And right now, the message is clear. Korean traders are far less excited about crypto than they were during the hotter parts of the cycle. But again, this does not have to be purely bearish. Markets often rebuild when attention is low, not when everyone is screaming about new highs. If Korean retail demand is weak, that tells us we are not in a full mania phase. It also means there could still be room for future demand to return if Bitcoin stabilizes, altcoins recover, and global risk appetite improves. A lack of retail euphoria can feel bad in the short term, but it can also mean the market is not yet overheated. So where does that leave us today? Bitcoin is under real pressure. The geopolitical shock from Iran, the $1 billion liquidation event, the loss of $75,000 support, and the upcoming Treasury liquidity drain all create a difficult short-term setup. Anyone pretending this is nothing is not being honest. The market has weakened, and the next few days matter. If Bitcoin cannot reclaim key levels, the move could extend lower. But at the same time, this is not the end of the crypto story. Regulation in the US is becoming more constructive. Major platforms like Kraken are still launching new Bitcoin products. Leverage has been flushed out. Long-term holders are still watching for opportunities, and the market has survived far worse than this before. The professional way to look at today is simple. Do not panic. Do not chase leverage. Do not assume every red candle is the end of the cycle. Watch liquidity. Watch Bitcoin's reaction around $73,000 to $75,000. Watch whether Ethereum can reclaim $2,000. Watch whether XRP holds around $1.28 to $1.30. Watch Solana around $80. And most importantly, watch whether buyers step in after the forced selling slows. Today feels uncomfortable because the market was positioned for calm and got hit with conflict, liquidity stress, and forced liquidations all at once. But these are the moments where discipline matters. The tourists panic. The leveraged traders get wiped out. The serious investors slow down, look at the data, and wait for confirmation. That is the message for today. Bitcoin is wounded, but not finished. The market is under pressure, but the long-term crypto infrastructure is still being built. And if this cycle has taught us anything, it is that the biggest opportunities often appear when everyone else is too scared to look properly. Drop your thoughts in the comments, smash like, follow, and we will see you at the top.